Howdy, Jacob here. Today we're looking at Blackbaud in the software industry. 3.9 billion market cap, 4.9 billion enterprise value. Super high P that we're seeing right now, but margins might be contracted, which maybe a little bit, but growth is pretty impressive. Definitely 10 years ago had higher growth than they do now, so their growth has slowed, but you are seeing positive growth. Gross margin has increased, operating margin down a little bit. We'll see whether that's due to R&D or not. And that's heavily impacted the return on invested capital to be 1%. So they have doubled their R&D. So that's good. That's investing in yourself now for hopefully future, you're taking money now to get hopefully more later. And so that could be a positive sign. SG&A up well over double. Cost of goods sold less than double. So not too bad here. Shares going up a little bit, but nothing terribly concerning. Probably just stock-based compensation. And they are pretty heavy on the stock-based compensation side, meaning that their free cash flow is going to look very high, but we are going to have to incorporate that stock-based compensation as an increase of shares. And so their use of capital has been mostly acquisitions. They used to pay a dividend of 23 million, which they could have easily afforded on the free cash flow side, but I'm fine with them reducing that to nothing so that they can really focus on making advantageous acquisitions and buying back shares that are hopefully extraordinarily cheap. The balance sheet, their enterprise value was about a billion greater than their market cap. So let's look at this. So 31 million cash on hand, 19 million short-term debt, 760 million long-term debt. They do produce about $200 million of free cash flow a year, so that's less than 4 years of their free cash flow. That's not a huge. It's higher than what I want, but it's not so concerning that they need to reduce that debt immediately. I think if they do allocate 20 to 30% of their free cash flow each year to that, yeah, it dwindles down their capital allocation towards advantageous things that really increase and push up the value of a business, like acquisitions and share repurchases. But sometimes that's a necessary thing to do. So let's start making our assumptions here. I think on the revenue growth side, I'll probably stick with maybe 5%. I think that sounds pretty reasonable to me. And then I think if they allocate a little bit of capital, the enterprise value will be pretty close to their market cap at the end of 7 years, but still not quite there. So maybe give me a 13 on the price earnings, price to free cash flow. For margins, maybe their net income will go up a little bit higher to their free cash flow. And so maybe let's do somewhat of a range here. Maybe let's do 14, 18. Share repurchases, 40 million, but they are increasing at 170 million. So this is saying 170 million would be, 85% of their free cash flow going towards share repurchases. I don't think that necessarily makes sense. Maybe just keep it even. And that's saying even still that 50 to 60% of free cash flow goes towards share repurchases, but still leaving maybe 20% to acquisitions, reinvestment, and then 20% to um, paying down some of that debt. And right now, yeah, it just doesn't look extraordinarily cheap. We're saying it needs to fall 70% to get to the return looking for here. Again, that's as expected. I'd expect 90 plus percent of the businesses that I'm looking at, especially in a all-time high market like this, where it's not going to fall exactly in the price that I'm looking for here. But I'll just be waiting until it gets to a more attractive price to do more research on it. Till then, I'll be looking at more stocks. Hopefully, you enjoy the video. Have a great day. Thank you.